Hey, hello folks, good afternoon and welcome to today's workshop. My name is Jason Hamilton. I'm the founder of Keep It Simple Financial Planning, and I want to welcome you to our workshop today. Today's workshop is actually a little bit different. I decided to implement one of the questions, or actually do a workshop on one of the questions that some of our members were asking about. So there's quite a discussion this last week about using a home equity line of credit, also known as a HELOC. And so I figured I would, one, provide some information and some education, and two, talk about the overall concept of putting one in place before you retire. So hopefully you enjoy this today, and hopefully you find it useful. So without further ado, we're just going to jump right in. And as always, I would appreciate if you leave any questions you have down in the comments below, and I'll do my best to answer those before we wrap up today. And then at the same time, I always forget to ask you this, but if you can like this video, share this video, and follow my page here, I would really appreciate it. By liking and sharing the video, it's going to allow more people to get this information, so it's very helpful if you do that. I definitely would appreciate that. So today we're going to talk about, should you get a HELOC, also known as a home equity line of credit, before you retire on your home? So let's just jump right in here. Right before we do, I need to let you know that this is meant for educational purposes. It should be seen as general education, not legal, tax, or investing advice of any sort. Make sure you talk to your financial advisor or tax professional before you implement any strategies we talk about here. But without further ado, let's go right to our workshop today. Okay, so I want to just make sure we're all on the same page here because we have a widely different set of knowledge levels when it comes to general financial concepts. So I'd like to keep things very simple. And so let's just start first with talking about what is home equity, okay? Because home equity is what you're essentially going to use to, when you apply for your HELOC, you're going to use your home equity to apply for a line of credit so that you can access that home equity if you were to need to in the future. So what is home equity? Home equity is the value of a homeowner's interest in their home. In other words, it's the current portion of your home's value that you would keep after selling your home or paying back any mortgages or liens owed. So essentially, if you have a home, let's say you just bought it and you put 20% down, if it's a $500,000 home and you put 20% down, you would have a $100,000 down payment, which would be $100,000 in equity. Over time, generally the equity is going to increase, but that's the amount you would get to keep if you were to sell your home again right away, minus any fees, of course. But over time, the home equity is a portion that you own of the home value, and then the remainder is what the lender would essentially own at that point. All right, so how home equity works. So if a portion or all of your home is purchased using a mortgage loan, your lending institution maintains an interest in your home until your mortgage loan is fully paid as agreed. For most people, this is either a 15 or 30-year term. Home equity is the portion of the home's value that the owner possesses at any time. When you first purchase your home, your equity is your down payment. Over time, your equity generally goes up due to mortgage payments being made and the value of the home increasing. So now let's talk about what is a HELOC, okay? A HELOC is short for Home Equity Line of Credit. A home equity line of credit is a revolving line of credit, usually with an adjustable interest rate, which allows you to borrow up to a certain amount over a period of time. HELOCs work in a similar manner to credit cards, where you can continuously borrow up to the approved limit while paying off the balance. So essentially it just sits there available to you until you need it. There's some differences between HELOCs and credit cards, but overall the concept is the same. If you need money, you can borrow it, you pay it back at the specified interest, and if you don't need it, the account just sits there not being used. So very similar to that. The big question is, should you take out a HELOC? Okay, so we're going to talk about this a little bit in more detail, but I think this is a relatively simple decision for some people, but there's also folks that are very, very much against having any sort of debts, okay? So there are some risks to taking out a HELOC as well. And if you have your home completely paid off and you take out a HELOC, well, it's very easy to potentially go back into debt and take money out against your home. And then, we're going to talk about this as well later, but you can honestly lose your home if you can't pay your HELOC at some point. So these are things to consider. But if you are very responsible with credit in general, you have other money set aside, somewhere in your savings, then taking out a HELOC could be a good solution and could be a better way to handle your finances if you need a big chunk of money, especially after you retire when it's a little bit more difficult to get a loan. All right, so if you have more than 20% equity in your home, you may be able to qualify for a home equity line of credit. Many times in the past, you could easily get up to 100% of the home value access, but that's not the case generally anymore. But a HELOC is a convenient and often inexpensive way to borrow money using your home's value as collateral. You don't have to get a HELOC from the company that services your existing mortgage, by the way. You can shop around and see from a number of lenders at this point. Having the internet has been a beautiful thing. It's made it very easy to shop around for things like HELOCs. And you want to make sure you get the best rate and the best terms that you can possibly find. You also don't have to use a line of credit that is available, but you can have the peace of mind knowing that it is there in case of emergency or to fund a large project if the opportunity arises. So if you're somebody that might be going into retirement, it might be good for you to have this available if you're looking to do some projects and possibly, let's say, all your money is in a pre-tax account like an IRA. If all of your savings beyond your emergency fund is in an IRA, well, if you wanted to take out, let's say, an extra $100,000 or $200,000 in one particular year, you can see a significant increase in your taxes and possibly other things like Medicare. You could be paying a higher Medicare surcharge. We talked about this last week on how that works. So these can be a useful tool if you might want to do some things like repairs and pay back the loan over time and control your tax brackets. So again, that's really the way I would see this being the most advantageous. I wouldn't want you to take out a home equity line of credit if you have no other money aside because you are potentially risking not being able to pay that back. But let's look at how a HELOC works and whether its unique features might make it a good or bad option for you. So how does a HELOC work? If you understand how credit cards work, you already have a basic understanding of how HELOCs do too. With a credit card, your lender establishes a credit limit based on your income, assets, and credit score. You can spend as much or as little as you like as long as you stay under the limit. But we don't advise using a HELOC for daily expenses like a credit card. Your credit limit for your HELOC is based on the amount of equity you have available in your home. There is a draw period, typically 5 to 10 years, during which time you have access to funds in your credit limit, and then a repayment period, generally of 10 to 20 years after, when you can no longer get money, but must instead pay any outstanding balance back with interest. So you can see here that how this could possibly get you in trouble if you're not financially astute and really set up to make sure that you're in a good place to take advantage of a HELOC. But while the basic concept of a HELOC is similar to a credit card, there are some notable differences you may want to consider. The first thing is underwriting standards. HELOCs are subject to underwriting standards from lenders, which means that you will need to document your income and employment status as you would if you're refinancing your home mortgage. So this is different than, let's say, a credit card. When you apply for a credit card, you're asked to provide information about your income and employment, but you do not typically have to document it. Note that not all borrowers will qualify for a HELOC, and that qualifying for a credit card may be easier in general. But this is where you may want to consider getting your HELOC in place before you retire. While it's not impossible to get a HELOC after you retire, HELOCs in general and just loans in general can be a little bit more difficult to obtain if you do not meet traditional underwriting standards. And some things that we saw in this most recent COVID crisis were that lending institutions decided to stop offering products like HELOCs because there was just so much uncertainty in the market. So, typically this is how banks work. It's like when you don't need the money, they're happy to lend it out, right? When everything's good, market's great, you have a good job, everything's looking wonderful, they're very happy to lend the money out. But when things turn in the market, sometimes these can be more difficult to get. And so even large institutions were not offering this product when the coronavirus first hit back in early 2020. So again, this is why you might want to consider getting your HELOC in place while things are good, while you have income, and before you retire, just to make things a little bit easier. Again, not saying it's impossible if you're already retired, but it's just a little bit easier in this case. Let's talk a little bit about interest rates here. So HELOCs, like most credit cards, have variable rates that change over time with rates in the economy. With a credit card, your interest rate is based on a benchmark interest rate, such as the prime rate or the London Interbank Offered Rate, also known as LIBOR, plus a margin or markup that is based on your credit score, repayment history, and how much the lender needs to charge to potentially earn a profit. HELOC interest rates are priced similarly. However, HELOCs often have significantly lower interest rates than credit cards due to the collateral, giving the lender a cushion if you default. So, if you have a HELOC, if you default, there's a home there to back that up. So that's a lot lower risk than, let's say, a credit card, which generally are not secured by anything except your word, essentially. So interest rates are definitely balanced out with the risk of a loan. So that's why credit card interest rates are higher. So that being said, when interest rates increase, people who thought they were borrowing money cheaply could find themselves stuck with HELOCs whose interest rates are comparable to credit card rates. Again, this is not as common in these recent times with interest rates being so low, but in the past this has been the case. There is also the possibility of getting a HELOC with a fixed rate. So in this case, a loan will often have a variable interest rate during the initial draw period and then converts to a fixed rate for the repayment period. Okay. Interest deductibility. So this is one where a lot of folks really got hurt by the TCJA, the Tax Cut and Jobs Act, that they were getting a deduction before, or you could easily get a deduction, and some things have changed here. So let's talk about that. So unlike credit card interest, HELOC interest can sometimes be tax deductible, but now only if the loan is used to buy, build, or substantially improve the taxpayer's home that secures the loan. Okay. So previously, you can basically take a HELOC on your primary loan and then use that to, let's say, work on your vacation home or maybe a home you wanted to flip and still get the deductibility. That's no longer the case. So according to the IRS, this provision was made law starting in 2018 by the Tax Cut and Jobs Act of 2017 and is currently slated to go away in 2026 when the previous situation of tax deductible interest for any loan purpose is slated to be reinstated. So we may see some other legislation sooner than that based on the new Biden administration that they are talking about possibly changing tax laws again. So we'll see how that goes. We don't know any direct information yet. And by the way, next week, I will be talking about some of the proposed changes in the Biden tax plan. So please be sure to join us next week for that. The TCJA also nearly doubled the standard deduction, making it less likely that most taxpayers will find it advantageous to itemize their deductions. So very few people qualify for deductions above the standard deduction anymore. But still, the tax deductible interest option may make the HELOC additionally attractive in some cases. So what's the bottom line? The bottom line is if you want to borrow against the equity in your home using a HELOC, make sure you understand how it works. In particular, you need to know when and by how much your interest rate might change before you borrow. Would you be able to afford the monthly payments if they go up later? This is a big deal. Okay, so if you have money set aside and you had some savings, then that's a good chance that you're going to be just fine with that. But if you're somebody that's going into retirement with very low savings and you want to have a HELOC and your home is really your main asset going into retirement, this is going to be a much bigger decision for you because if you can't afford the payments later, you could potentially lose your home. This could be a very, very bad situation. Okay. Also, how much of an increase can you stomach if the payments were to go up, if interest rates go up? That is a possibility right now that we could say interest rates go up, but it may not be for a few years. And then will the things you want to purchase with your HELOC money still be worth it at a higher interest rate and possibly with no tax deduction for the interest? So there are people that use their HELOC like a credit card. I don't think that's a great idea, but I think it's a good thing to have in place as a potential parachute if you were to have some financial issues or you needed to draw a large amount of money and you were potentially, let's say, retiring early. Let's say you might be somebody who is going to be retiring early and before 65, for example. If you retired before 65 and you don't have health care offered from another source, you may be looking at utilizing the exchange, the healthcare exchange, also known as an ACA plan or the Obamacare plans, and those are income-based plans. Okay, so if you are married, it's just under $50,000 now of income that you can make and still qualify for a potential subsidy with your healthcare. If you are married, it's just about $69,000 at this point. So if you are going to need to have a big, source of income to cover you somewhere between now and 65, if you're going to retire early, if you were to have, let's say, a big home repair or something like that were to happen, and you had to take a big draw out of your IRA, that could potentially be a bad thing and really cost you a lot more than you're thinking. Not only do we have to pay the tax on the IRA, but if you go above the ACA limits, that could cause you to now lose your subsidy and have to repay that during tax season. So some of those subsidies can be up to $16,000 to $22,000 in 1 year. So you really want to be smart, and this is why some people are just so against debt, and I am against debt as well, as in a general sense. But I also think there's financial tools that are available that can be used in ways that can help you with a good strategy, especially when it comes to retirement. And if you can qualify for a subsidy on your healthcare and you have to use a little bit of your home equity, Well, this is not considered taxable income. So this will not necessarily put you over the limits per se if you were to have a home equity line of credit and need to use it along the way. So again, you want to be smart when you are utilizing whatever financial tools are out there. And most financial products in general have a good reason for being there. But a lot of times they're just either sold by someone trying to make a commission on it, or just utilized for somebody who really doesn't understand them. And those are the things I want you to take away today is I want you to understand how and why you're using this product. And if it makes sense for you to have it in place and you have good behaviors in place, then it could be a good tool. Okay, so let's go back to our conversation here. All right, so additionally, you should also think about how you plan to use the money and your past borrowing behavior to decide whether a HELOC is likely to help or hurt your finances in the long run. So a lot of people will use HELOCs to refinance things like credit cards. And that can be a good idea, I guess you could say, because you're going to lower your credit card debt from, let's say 20 to 30% down to maybe 2, 3, or 5%. But you are putting your home at risk as well if you can't make those payments. So if you have a habit of abusing credit and you don't really trust yourself to change your ways, you're probably better off leaving your home equity intact and keeping your debt on your credit cards. At the end of the day, your credit cards are non-recourse in a sense. I mean, they can sue you potentially, at some point, but if you don't have any other debts, there's not much they can really do comparatively to a HELOC, where your HELOC, if that were to go bad and you couldn't pay that, you potentially could lose your home. So if you're somebody that just does not have good financial habits in place, does not have a good savings aside somewhere else in another account that could pay back the HELOC if you needed to, then you really want to take that decision a lot more seriously. And make sure you don't put yourself in a bad spot and end up a lot worse. Okay, so again, debt can be used as a tool, but you want to make sure you're doing things intelligently and with a purpose, and not just getting yourself into more trouble by, let's say, refinancing all your credit cards, putting it on your HELOC, and then just go running your credit cards up again. Not good. Okay, that's not what we want to do. Okay, so we want to make sure we're doing the right things for the right reasons, and we're being smart with how we are managing our finances. Okay, and then finally, one thing I want to mention is as I was doing research for today, I found some things that you may want to be considerate of. So, I just want to remind you as well to always check in on your financial accounts. At least check in on a monthly. Make sure that nothing, weird is going on with your accounts. Something that I found is that identity theft, since it's becoming increasingly common, there are people out there that will potentially steal your identity, and then they could potentially use it to drain the funds from your HELOC while you're not paying attention. So this would be absolutely horrible. And again, you have to fight that case, right? And hopefully it will come back. But it's not like a credit card where essentially, you can just claim identity theft and not really have any issues and let the credit card deal with it. It's not the same type of situation. So you could put yourself in a bad spot. And so you want to make sure you're checking on your statements regularly. And this goes for all your accounts, by the way. It's not just your HELOC or whatever it may be. You want to keep a look. Check your credit report, pull it at least once a year. You can go to annualcreditreport.com to get that for free, or use an app, something like Credit Karma, that will allow you to access your credit reports pretty easily there. Okay, so finally, I want to invite you, if you need help with your retirement strategy and you want to discuss either how a HELOC may be implemented, if it's a good strategy for you, or if it might be a good idea to use that, like we talked about, to help you pay for healthcare so that you can stay under and qualify for a subsidy. These are all things that come into play when you're creating a retirement plan. So if you'd like to schedule an appointment, it's complimentary, and we can talk about your retirement strategy. And if it looks like you need our help, then we can talk about that as well. You can go to keepitsimplefinancial.com/talk. Once again, that's keepitsimplefinancial.com/talk if you need help with that. So I'm going to check now for questions. And again, folks, I do appreciate you watching. And if you could please share this video, even if you like this video, more people will see it. I would appreciate that because we want to get this information out to as many people as possible, to help as many people as possible make good, simple financial decisions, because that's what our goal is. So let's see here. I'm not seeing any questions coming in, so hopefully this is a good workshop and you learned something today. Like I said, next week we're going to talk about the proposed changes with the new Biden tax plan. Okay, there are some things that are generally going to affect people that are making above $400,000 of income. That's a majority. But there's also some things that possibly could affect you if you're below that. Some things that might be good and some things that might be bad. So I'm going to walk you through exactly what we know so far, and we'll keep you up to date as we know as time goes on. But we'll talk about that next Sunday right about the same time. So please join us for that. And then the following weeks, we're going to be talking about taxes in retirement. So we're going to spend a few weeks talking about the different sorts of taxation and how not all money is taxed the same, and how you could be or should be thinking about this in the future. So Sean asked if the presentation is available online to watch it later. He joined late. Yes, absolutely. You can watch this later. It'll be here on the page or on the website. Everything, by the way, all of my previous workshops are on my website under our blog at keepitsimplefinancial.com/blog. And you can find a lot of information there. I mean, a lot of workshops, pretty much almost everything you need to know about retirements. The hard part is putting it all together for you and your situation. So again, hopefully you enjoyed this. I'm going to put it on my website one more time so that if you want to contact us, keepitsimplefinancial.com/talk. We'd love to speak with you. And other than that, folks, I'm going to wish you a wonderful afternoon, and we'll see you next week about this time to talk about the new Biden tax plan and what you could be potentially expecting in increases, decreases, or other possible benefits of this new tax plan. All right. Have a great afternoon, and we'll see you next time. Bye-bye now.